Alright, so before we start with commodities, let me clarify one thing. So in commodities, there will be a certain part towards the end particularly where we'll need to refer to derivatives. So those who have completed the derivatives lectures, it's absolutely fine, or those who have an understanding of derivatives, this will be absolutely fine. Those who do not, those who haven't completed derivatives, you may choose to ignore the commodities lecture right now and come back to it after completing derivatives. Just this commodities lecture. My opinion or my advice to you is do this entire lecture irrespective of whether you've completed derivatives or not. After completing derivatives, go through this part, barely a page or so. If there is any problem, revisit the lecture, redo the lecture. You will anyways absorb the content better. So my advice would be do it a second time if needed, but right now do it so that the entire alternate investment part is completed and you've understood what commodities is. 80% of commodities you will understand 100%. Commodities investment through derivatives will be a little bit of a challenge, but I will still explain that. I don't think you'll have a problem, but there will be areas where you'll have a little bit of, leave this part or leave these 5 words right now, that you will be able to, that you will understand anyways when I do derivatives. Right? Because derivatives, introducing 4 kinds of derivatives is almost a 10-hour, 15-hour lecture. And that's the whole derivatives is what is all about. So very interesting part. So anyways, let's start. So when you're looking at real assets versus financial assets is generally your stocks, bonds and all. So say for example, if I own, let's say a stock in ONGC, I will not be able to just borrow a liter of oil from ONGC because I've got shares over there. They are financial assets. They are representing my claim on that company, right? That I own a very tiny bit of share of that company, right? But when you're looking at real assets would be real estate, houses, the house you live in, the house you own and all, infrastructure, ports, airports, etc., in which you have invested. These are real assets in which there are investments are being done, or natural resources. So even when you're looking at farmland and timberland, they're natural resources. Farmland, agricultural produce, timberland, timber, wood, and commodities. My discussion right now is going to be around commodities. So let's discuss commodities. Now when you're looking at different kinds of commodities, you have precious metals, gold, silver, platinum and all. Gold, silver have utilities in electronic gadgets and all of these places. And gold again for jewelry, for as a store of value. When you're looking at base metals, you've got zinc, aluminium, steel, iron, nickel, etc. Energy, natural gas, oil again for transportation, one of the most prominent uses, coal and natural gas for heating purposes when you're looking at cooking and heating for countries up north, colder countries and all. Agricultural produce, grains, corn, maize, we have derivatives, we have contracts on these also, so people can invest in these as well. Livestock, don't want to discuss livestock, sorry. Commodities. So when you're looking at investing in commodities, what are the different ways in which you can invest in commodities? Understand what is commodities all about. So say suppose I want to invest in gold. I can very easily buy maybe a gold coin, give me 45,000, 47,000, whatever be the price at the moment. 22 carat, 22 carat generally I think. And even if you buy let's say 50 lakh rupees worth of gold, it will barely fit in a very small space in your drawer or something. It is very easy to hold. But say for example, if I want to invest in a commodity, oil, I cannot buy 50 liters of petrol and keep it at my place. It is very difficult to physically store these commodities. So one way of investing in commodities is to directly own the commodities. So directly owning is physical goods, physically owning them, which is possible for precious metals. But even if you want to, say for example, you cannot buy the entire year's worth of pulses and dal and keep it at home, right? It won't work. Because you're scared that what if the pulses prices are going to increase in the entire year? Let me buy it right now and keep. You can't do that. If you know there's probably let's say a wedding coming up in the family and you think gold prices will increase in the next 6 months, 8 months, 1 year. We've seen people who have accumulated, even if they do not know that what kind of jewelry to buy right now, they'll buy gold coins and then exchange it and get jewelry done later. But at least they have locked in their prices of gold by buying the gold today and keeping it. By buying the gold today and keeping it, you've locked in the price, you've frozen your price. Even if the price goes up, it doesn't matter because you've already purchased it. But you cannot do it in terms of other commodities. What is the risk we are trying to hedge over here? What is the risk we are trying to manage over here? Inflation. If the price increases, I'll have to spend a larger amount of money. Let me buy it today itself. That is what we are trying to do. Tell me, are you following this? So there is one mode of investment is direct investment, and even with respect to gold there is a cost of storage. For example, I would not want to hold gold in the form of what do you call it, physically in the form of and keep it at home. I would rather want to keep it in my bank locker. Bank locker also has charges. So normally, even when you're looking at precious metals, I'm not talking about somebody like me who will keep a 1 lakh, 2 lakh rupees worth of gold, but somebody who's maintaining huge amounts of gold and all, they would need to hire, they would need to insure their possessions and all. That becomes a challenge. Storage cost, transportation cost, and we can't even think about the storage and transportation cost if you want to own gallons of oil or tons of wheat and maize and corn and agricultural commodities. And there is a problem with rats and warehousing and storage, and agricultural commodities would be perishable as well. So there are going to be, and grading. What is the quality of rice? What is the quality of this thing? Gold and all, it's still fine because you know that what is a carat of gold. So that way you can still be comfortable around it. So there is major problem with storage and transportation costs and all. So direct investment becomes a problem. So owning commodities using a direct investment is a major challenge. Everybody with me till here. So we need a solution. So one of the easy solutions could be owning equity-linked commodity-linked equity stocks. For example, if I want to gain an exposure into coal prices, I can probably buy a Coal India stock. Oil prices, I can probably get into a refinery stock or a oil and gas kind of a stock. Maybe gold, Kalyan Jewellers, or what, Tribhuvan Das also probably got an IPO done, na? I'm not sure. I think these guys also got an IPO done. So I can look at these kind of companies as well. But then the problem is that these companies are not going to be 100% commodity centric, because they will also be more linked with or correlated with equity, because ultimate objective is going to be that I want to diversify. I don't want to put all my money in equity, because when two asset classes are going to be moving in opposite directions, or they are going to be relatively uncorrelated or low correlation, it will be my portfolio is going to get diversification benefit. The volatility of the portfolio is going to go down as compared to a high volatility. That is the objective. That is the reason why I prefer or I want to invest in commodities. But if I invest in commodity linked equity stocks, Coal India, ONGC, etc., they will behave more like the market, like the average market. So I will not get the desired correlation. That is definitely a way of getting into it. But then there are a lot of other risks now, operational risk, market risk, etc. when you're investing in companies linked to commodity. I want a pure commodity exposure. So this is not helping exactly, not a very good idea. Right? I've just mentioned this over here so that you at least know that yes, there is a way of getting exposure into commodity stocks as well. Kalyan Jewellers would depend on their making charges, what kind of products they are selling, what kind of margins they are keeping from the consumers, etc. A lot of factors were important. Tell me, are you following this? So what is the other way, or what is one of the most important ways, one of the most best ways of investing into commodities? That is through derivatives. There are 4 kinds of derivatives: forwards, futures, options, swaps. Each term, to explain each terms, I will take hours. This is covered in derivatives. Let me give you a very brief way so that you can understand the rest of commodities very easily. Derivatives is not mentioned throughout. These are all different things. Okay, so what is derivatives? Now what happens is there are certain contracts that trade on the exchange. Say suppose I get into a bet with you that right now the gold price is 45,000. Today the price of gold is 45,000. Suppose we both get into a bet. According to me, the prices after 6 months should be, let's say, the price at which you're willing to buy today is not going to be the same as the price at which you're willing to buy after 6 months. If you buy something today, today's market price is not necessary that after 6 months the price will be the same. I'll give you a simple example. If suppose today dal, I don't know what is the price of dal in the market, anybody any idea? 80 rupees, 90 rupees, I don't know. I have no clue. 80 rupees per kg is, let's say, price of dal today. So you go to your kirana store at the corner of your house, lane, and you tell him that okay, today dal's price is 80 rupees. Let me do a contract. I'm going to be buying 1 kg dal from you every week for the next 2 years, and I'll pay you 80 rupees. Will he do that contract with you? No, because inflation is there. Prices of dal will not be constant. Correct? Say for example, even if let's say you have harvest season for rice and wheat and all. So suppose the harvest season is in, let's say, April, March, April. So the price of rice in April and the price of rice in September will be very different, because if somebody is selling rice in April, they don't have to store. They are immediately going to be able to sell you rice. But for you purchasing rice in September, the warehouse will have to keep the rice for April to September time frame. They will have a storage cost, warehouse cost. There will be some losses because of damage to crops, damage to because it's relatively perishable, but still rice and all you can store it for a year or so. But still the price in September should be higher, because somebody had to purchase, block their money by keeping rice with them, keep it in their warehouse for in storage facility and all for 6 months, and then sell it to you after 6 months. Basically what I'm telling you is that today if the price of pulses or rice or something is 80 rupees per kg, that is a spot price. Spot price means if I buy something right now, immediately, that is on the spot, that is spot price. And say suppose if I want to contract that I will buy from you after 6 months this much kg of rice, that becomes a forward contract or a future contract, because that contract is going to get executed on a forward date, on a future date. I am not purchasing rice today, but I am making a purchase 6 months later. Tell me, are you following this? Let me give you another example. Suppose you are into construction of a flyover. You are scared that iron prices might increase. Okay, iron and steel prices might increase. What you do is you have a foundry or an iron steel rod TMT bar manufacturer. Now you go to that TMT bar factory and you tell him that today the price is this much X rupees per ton. I am taking this much kg. I want to do a contract that after 1 month, 2 months, 3 months, 4 months, I am going to be receiving this much ton, and the prices will be X, let's say X plus 1.2, X plus 2.2, X plus 4.2 per kg, whatever is your contract. You are going to do such kind of contracts. These are forward contracts or future contracts. Simple meaning is that I am going to do the contract today, but the execution will happen later. We are deciding on the price today that after 6 months I will take this much from you, but the price is being decided today itself. Tell me, are you understanding? So when I buy something today from the market, that is at time zero. Today I am buying it spot prices. If I contract that after 6 months, I am contracting that you will supply me this much amount of this raw material. Say for example, a tire manufacturer. It has done a contract with the rubber plantation that after 6 months, this much kg of rubber at this price I am going to take. We are doing the contract today. Because the tire manufacturer also has to set its MRP and everything in the market. So they also need to be very careful about what kind of raw material prices they are paying and what will be their cost and all. Accordingly, they will price their products in the market. They are derivative contracts. We investors in commodities, it is very difficult for us to gain physical exposure, physical direct exposure, because I cannot bring oil at home and keep it. So there are kind of एक तरीके का bet है, आप समझ लो. It is more like a betting kind of a transaction if you can think of it that way. So basically what I'm saying is, say suppose both of us have a bet that price of gold is going to be 47,000. We are going to contract that I will buy gold from you at 47,500, let's say. After 6 months, I will buy gold from you at 47,500. We have done this contract, me and you. Now after 6 months, if the price of gold is 49,000, I will benefit or I will lose? I will benefit, because I have done a contract that I will buy gold from you at 47,000. I can sell that gold in the market, 47,500, and I can sell that gold in the market at 49,000. 1,500 is my benefit. You are going to make a loss. Say suppose today we did the contract that 6 months later I will buy the gold from you at 47,500. You did not have gold. After 6 months, what will you do? You will have to purchase gold from the market at 49,000 and sell it to me at 47,500. You are losing 1,500. Think about it. Think about it. So I'll just scribble it at the side. So this is time 0 and this is after 6 months. So we have decided that me and this is you. I have told you that I will give you 47,500 and you will give me gold. Okay? Following this? Now if the gold price is 48,000 or let's say 49, we'll continue with the same. 49,000, I will still get gold from you at 47,500. I can sell it in the market at 49,000. I'm getting 1,500. Did I have gold at time 0? No. Did I have gold at time 6 months? No. I bought the gold from you and I sold it in the market immediately. Say suppose you also did not have gold. At 6 months, you have done a contract. You will have to buy gold from the market at 49,000 and sell it to me at 47,500. That is, there is a 1,500 loss. Say, suppose, let me modify this transaction a little bit. Let's say both of us have gotten into a bet. Bet को क्या बोलते हैं? जुआ नहीं. What do you say? शर्त लगा है. So we have gotten into a bet. Now the bet is, I am betting that gold price will be below 47,500. You are saying that no, gold price is going to be, no. I am saying gold price will go above 47,500. You are saying that no, gold price is going to go below 47,500. And lag gayi 100 ki. So that is what we have done. We people have gotten into a bet. If the price of gold goes up 47,500, we have discussed, we have bet that you will pay me the difference. And if the gold price goes below 47,500, I will pay you the difference. Since the gold price went up to 49,000, you owe me 1,500. Same as this one. If gold price was 47,000, in that case, what will happen? I will have to buy gold from you at 47,500 and I will have to sell it in the market at 47,000. I lose 500. You will be able to buy the gold from market at 47,000 and sell it to me at 47,500. Your profit is 500. It is same as betting on the price of gold. We have bet that I am betting that gold will increase. You are betting gold will decrease. And we have kept a level of 47,500. If gold went down, I lose, I have to pay you. If gold goes up, I win, you have to pay me. Ultimately, did anybody own gold? No. We are just betting on the price of gold. And based on the movement, we are exchanging that amount. That is what derivatives is. So without actually physically owning the commodity, I can bet on gold, I can bet on oil without keeping oil at home. I can bet on agricultural produce without betting on that agricultural produce. That is what derivatives will do. So right now, just simply ignore this part. Ignore the difference between forward, future option swaps. Forwards and futures are contractual obligation. Options is a choice. Option itself I'm going to teach you for 5-7 hours at least. And this is brilliant. Derivatives is super interesting topic. So once you do derivatives, you'll understand the 4 different kinds of options. And these are exchange traded. I just wanted to not leave out anything and complete commodities in totality. That is why I discussed this over here. But basically what we are doing is, it is very difficult to physically own the commodity. So what do? We people can get into contracts. Derivatives are contracts. We have contracted that after 6 months, I will buy gold from you at this price. If price increases, faida, I benefit. If price decreases, your faida, you benefit. And we will actually not buy gold, sell gold, etc. We are simply going to exchange the difference between the prices, the 2 prices. Following? So based on this betting, I can gain exposure on commodity as to how the prices of commodity is changing in the market. Tell me, are you following this? So this is, we are going to use derivatives in order to take exposure into commodities. For gold and all, it might be okay to take direct investment. But otherwise, when you're looking at commodities, commodity derivatives is what we are going to use. We are going to be using commodity derivatives. And equity, not a very good idea. Does not provide that level of diversification benefit. So derivatives is simply betting on the price of commodity. So you can gain exposure without owning the commodity, without buying or selling the commodity. Whatever is the price increase or decrease, you can gain exposure to that. Just understand this much right now, if you do not understand derivatives. This example also I'll take an hour to explain in detail and all. It's very interesting, derivatives. Options is one of my favorite topics in finance. Tell me, are you understanding this? Options and equity also. Portfolio as well, actually. Anyways, getting back. So what are the other ways of investing into into commodities? So there is something called commodity ETFs. Now what happens is, there are multiple ways. Let me take the example of gold. There are multiple ways of investing in gold. One is to physically own it. Second, we have sovereign gold bonds that the RBI, the banks issue, central bank. You get even a 2.5% interest on that. So basically what happens is, central banks and all have to maintain gold reserves. The gold that we keep at home is absolutely not benefiting anybody. What happens is, and it is also difficult, insurance cost and all I told you. So now what happens is, we can gain exposure to gold by owning something called an ETF. So let's say there is an ETF. That ETF is basically nothing but a fund in the market. A fund that trades like a stock. What happens is, say suppose ETF is trading at what I think 800, no, there are different ETFs at different prices. SBI Gold ETF also have a small amount, Kotak ETF I have a little amount, and I have, there was one more I say nahi hai. I think Reliance, no, Kotak, Reliance only, Reliance, pata nahi, whatever. So I've got this 2-3 ETFs together, and that is a small amount of gold investment, but I think the best way of investing into gold is sovereign gold bond, according to me. So anyways, in ETF what happens is, we all investors, one ETF share could be costing you 500,000 rupees. Very small amount of money. So we people put in, let's say 1,000 crore rupees worth of gold. 1,000 crore rupees worth of ETF, total sum that we people have bought. Now that 1,000 crore worth of gold is kept in a vault in some central bank or somewhere. We have claim on that. Now what happens is, that 1,000 crore, let's say, is represented by 1 crore shares. 1,000 crore rupees, 1 crore people have bought 1 share each, and you have 1,000 crore rupees together. That 1,000 crore rupees worth is used to buy gold and keep it in a safe place. Now if gold price increases or decreases, the value of that share goes up and down, because that share represents ownership of gold. And we people can buy and sell those shares between each other. So if I am buying a gold ETF, it is not that I will pay the money to the ETF and the ETF will buy new amount of gold. We people will trade the shares of gold ETF between ourselves. So the amount of gold is constant over there, unless they want to increase the quantity of gold and issue new shares. Tell me, are you understanding? Are you getting an idea? It is again like a gold ka mutual fund, where we people have contributed small amount of money and there is a huge amount of gold repository, and that is stored in some central bank or something. Tell me, are you understanding this? You're following this, right? So that is representing a claim on gold. So we are holding gold in e-form, demat form, dematerialized form. Instead of holding in a physical form, we are holding it in the form of ETF. And when you're pooling in that, the insurance and the storage and everything becomes much easier and safer, very safe. That is one way of investing into gold. So there could be other kinds of ETFs also. Gold ETF is one of the example. You can have other commodity ETFs as well. I don't have a silver ETF in India. I want to invest in silver, not getting the opportunity. But then when you're looking at developed market, there could be oil ETFs and all. Tell me, following this? So one, the advantage of ETF is suitable for retail investors because we people want to invest small amounts of money, right? And second, invest in commodities, or it can also invest through commodity derivatives. Now for me, it is very difficult. I do not do FNO, so I do not hold an account with futures, options and all that trading. I do not do FNO by choice. So when you're looking at commodity derivatives, so the ETFs, we can invest into ETFs, and ETFs can invest through commodity derivatives. The derivatives, the contracts and all I was talking about. So ETF can have their manager who's managing and investing through commodity derivatives as well. Tell me, following? So ETFs can either invest directly into the commodity or through ETF. For gold and all, I think they can invest directly, but when it comes to pulses and grains and all of that, agricultural commodities and all, oil and all as well, it will be easier for them to invest through derivatives. There are continuous oil derivatives in the market. See, airline companies are scared that the oil prices might go up. So they will use these derivative contracts to manage their risk so that they can lock in their price. So we'll study these things in derivatives, don't worry. But you have a basic, you're getting an understanding, right? Apart from derivatives, other things are 100% clear? Sure. Next is your managed futures. So managed futures, there is somebody called a commodity trade advisor. 1 second. I keep forgetting the terms. Commodity trading advisors, commodity trade advisors, commodity trading advisors. So managed futures is basically, okay, let me put it this way. So we have a basic understanding of what hedge fund is. Managed futures is formed in a very similar structure like a hedge fund. Like a hedge fund was Amir Log ka mutual fund, we had said, not too much of a restriction, do whatever you feel like, generate a lot of returns. Managed futures is like a hedge fund investing into commodities. It's like a hedge fund of commodities. So you invest in commodities, you take a lot of risk and all, get exposure, generate good amount of returns and all for us. So managed futures, so when you're looking at managed futures, it's more like a fund. A fund where again people pool in a lot of money together and they appoint a professional manager. This professional manager is known as CTA, Commodities Trading Advisor. CTA, Commodities Trading Advisor. And this guy is going to be actively managing commodities. This guy is going to be actively managing commodities and commodities investments, right? So now there could be managed futures which are sector specific. So maybe there is a managed futures into energy sector. So this managed futures, this fund is basically investing into only energy related commodities, let's say oil, natural gas and all. There could be a managed futures, maybe that is into totally based into industrial metals. So because there are metals and all are consumed by industry, so depending on which industry is booming, how the business cycle is, accordingly I will invest into those metals and all. Possible. That is this. Acha. So, or it could be diversified. Now for me it is very difficult to buy 5 different commodities and gain exposure because I have a small amount of money to invest into commodities. But it is possible for a managed futures account, futures fund to be able to diversify and gain exposure into multiple different commodities. Tell me, following this problem? Okay. The managed futures can be structured like a hedge fund or it can be structured like a mutual fund. If it is structured like a hedge fund, the fees and structure, limited liability, partnership and all will be like hedge funds. So in hedge fund, you will anyways study how the fees is, the LLP, the restrictions on liquidity and all. So we will study. So it could be structured similar to hedge funds. So when you study hedge funds, all these characteristics are covered over there. Or it can be like mutual funds, and mutual funds is advantageous to us retail investors. Because mutual funds, we can invest small amounts, investment size is small, liquidity is high, we can sell shares to each other, right? And that we can get benefit from professional management. So retail investors can benefit if there is a mutual fund, because I do not have the money to buy 45,000 rupees worth of gold. But if I have a commodity based mutual fund, I can invest 5,000 rupees over there, and they can not only gain exposure into gold alone, but gold, silver, multiple metals and all. Because they've already pooled in thousands of crores and there is a professional manager to take care of it. So either you can have a managed futures structured like a mutual fund or structured like a hedge fund. So mutual fund people can invest easily. Why do you call it managed futures? Do you understand now? Is it easy to take investment, physical investment, direct investment into commodity, or is it difficult to make investments into commodities? Difficult. So what is the alternative? Derivatives. Futures is one of the types of derivatives. And we want active management or we want passive management here? We want active management. We want the commodity trading advisors to be able to buy, sell, forecast, etc. So what is their job? To manage futures, to keep doing that buying, selling. It is not like khareed ke rakh lo ghar pe, buy and hold. That is not the strategy here. Because we have to use derivatives. That is why managed futures. So what is managed futures? Professional manager who understands commodity and all, obviously he'll use futures. He will managed futures and generate return. You can structure it like hedge funds, you can structure it like mutual funds. If it is mutual funds, it's good for retail investors. You can invest small amounts of money also. If it is structured like hedge funds, then the characteristics will also be like hedge funds, which you will study when you cover hedge funds. Tell me, comfortable? Easy, managed futures. And the third is specialized funds, very easy. You can have specialized funds, energy focused fund. You can have agro-based fund, which is investing into agri-based agricultural commodities and all. So you can have specialized funds. They can structure anyways, commodities, derivatives ke through, LLP structure, hedge fund like structure, mutual fund like structures. So you can have specialized funds, and specialized funds would be advantageous if I want to gain specific exposure. Say for example, if I think that equity markets are doing bad and because of that I think gold prices should go up, I might want to gain exposure on precious metals but not everything else. If I think monsoons are going to be bad, because of which agricultural prices, products prices are going to increase, because if monsoon is bad, the harvest is bad. If harvest is bad, in that case supply is short. Supply is short, price of agricultural commodities will increase, and therefore I want to take exposure. So I do not like all this managed futures and all. All I want to do is I want to gain exposure into agri-based commodities. So I'll probably buy a specialized fund which deals into agricultural commodities. Tell me, making sense? So these are other ways of gaining exposure, but ultimately what have we seen? So either you directly own it, gold, silver ke alawa kuch nahi hoga. You will not be able to do anything beyond gold and silver. What is the second alternative? You invest through equity, bad diversification. But still, better. You have at least a way of investing. Best way, derivatives. Derivatives, difficult to do it personally, so better to hire funds. So if you can afford hedge fund, it can be structured like a hedge fund or a mutual fund. Simple, complete. Or ETFs for gold and all that, for whatever ETFs are available, where it's like a fund pool together, and that pool, that ETF, exchange traded fund, is investing into these things. ETFs also we covered in a detailed manner in portfolio. So of course at the beginning, there'll be more interlinks between different subjects. So once you've completed, once you have the basic idea of equity, portfolio, risk, etc., you'll be able to put all of these things together. You had a question. Done? Next part is, so when you're looking at commodities, what is the rationale behind investing into commodities? Why do I want to invest in commodities? Where will I generate return from commodities? So the return from commodities is going to come from change in price. Price of oil increases, price of maize increased, price of gold increases or decreases. So the return, when I'm investing into commodities, I need return. So where is the return coming from? From changes in price. There is no income over here. Gold अंडा नहीं देता है. When you invest in equity shares, you will get dividend. When you invest in bonds, fixed income securities, you get interest. But here you do not get anything. In case of commodities, there is no recurring income. There is no income that you generate. You're understanding this? So whatever return is going to be, it is going to come from price. And why will the price fluctuate? How will the prices fluctuate? Commodity prices cannot be calculated based on present value of future cash flows. In equity, you can say, okay, this company will generate so and so profit in the future years, so I will discount the profit and that is the value of the company. If I invest in a bond, I will get these many interest and coupons and cash flows and all. So the value of the future cash flows is this much, therefore I'm willing to pay this much for the security. You can do all those things for cash generating, for revenue generating when you have future cash flows. Then you can use discounted cash flow method. Then you can discount the future cash flows to do the value. If I buy gold, how will you discount future cash flows? And please don't tell me 2% of sovereign gold bond. That is not how it works, because that is not the reason why you invested. That the gold is giving you a little small amount of return and that is peanuts. That is not why you will invest. Are you investing for 2.5%? Then keep your money in savings account only. Tell me, are you understanding this? So when you're looking at equity, commodities, etc., when they have future expected cash flows, we can value them based on discounting future cash flows. But for commodities, it is based on demand and supply. It is based on demand and supply. For example, there is a sudden demand of semiconductor chips. So the prices increase. Of course, there could be, India would come up with a couple of factories on semiconductors and all, but that will take a couple of years to get started and get running. But right now there is a shortage. I gave you that example that if there is major rainfall or flood in your city, the next week you will see, or the next few days you will see, prices of vegetables, tomatoes and etc. are very, very high. It is not that tomatoes have become tastier or something, but there is a demand and supply issue. And you know that in a couple of weeks or in a few weeks time, the prices will again normalize. But you cannot eat for a few weeks later. You don't have a derivatives on bhook, on your hunger. Okay, I'll contract to eat 6 months later, 1 month later. So your price, your change in price is based on demand and supply. Shortages in supply, demand increases because of something, because of EV now, electric vehicles. You have a major demand for lithium ion and all. So because there is a demand created because of a product being introduced in the market, so there is a demand. So there is no income, regular income. The return generated from commodities is from price change. And the price also does not depend on future cash flows. It is calculated based on demand supply. Right? Now, when you're looking at the returns of commodities, return of commodity is lower than bond. Obviously, fixed income security give us lower return as compared to equity because they're less risky. The return you'll get from Tata Motors is obviously going to be more than the ideally it's supposed to be. What you'll get is a different question altogether. But the return is supposed to be less than, your return is supposed to be more from equity shares as compared to your fixed deposit and all. Obviously, that is the reason why you take risk and invest into equity. Return on commodities is even lesser than the return on bonds and all. Now your question would be then, why are we investing into commodities when the returns are lower? Because our objective is not just earning high returns. Earning high returns to go start gambling. But then you have to also look at the risk factor. Our objective is always to earn highest amount of return for a given level of risk. So we want to increase our return per unit risk. For every 1 unit risk that you take, I want to generate maximum return. Sharpe ratio, I want to maximize my Sharpe ratio. That is the ultimate objective. You cannot look at return from very in a singular manner, right? In a very what do you call the word? No, not narrow, matlab, alag se, matlab, individually, not specifically also. Not look at silos. Silos is also not a good word. Anyways, forget it. So return on commodities is lower than bonds and equity both. Why do we invest into commodities? Because the correlation of commodity with bond and the correlation of commodity with stock is lower. There is diversification benefit, therefore we invest into commodities. Because I am not looking at returns from commodity or equity or bond only. Ultimately, I want to see what is my total return from the portfolio, which includes equity, bond, commodity, everything, and the risk of the entire portfolio. So although it may not be adding, let's say it is adding a small amount to the return, but it is reducing my risk considerably, then what? Commodity turns out to be a good investment vehicle. This you will again understand once you complete portfolio. So as I told you, you will have interconnections between topics. Tell me, are you following this? Right? So we are going to be looking at things from a portfolio perspective. As a whole, how are things? So maybe my return went up by this much, but my risk went down by this much because of adding commodities. So on an average, when I look at return per unit risk, this ratio increases. Because of commodity, my return went up by this much. Commodity did not add great amount of returns, but because of commodities, my risk went down considerably. So on the whole, my ratio of return to risk is increasing. Are you following? So this is why we want to invest into commodities. Now when you're looking at returns of commodities and all, it is possible that speculators can generate higher amount of return. Speculators can profit from short-term fluctuations if they are correctly able to forecast. So say for example, there are traders and all who study geological data. I was going through some climate bonds and some content and all. I was reading for something actually, and I started enjoying reading the geography part and all. So I want to study a little bit of geography, and I was reading this book also, this one, A Short History on Nearly Everything by Brian Bryson. So this, I was reading about Ice Age and evolution and all of that. So it's a very interesting book, very interesting book. So I'm actually halfway through. I've not completed the book and I don't remember where's that book. I'll have to go and search today. So anyway, so when you're looking at these factors, there could be geological data, etc., that you're going to study, and based on that, you will try to make short-term forecast and try to bet on it. So in the short term, speculators, those who are betting, speculators are those who bet, not consumers. Consumers are those who are going to use it, consume it. For example, MRF Tire is a consumer for rubber. Larsen and Toubro would be consumer for iron and steel, construction activity. Correct? But say for example, somebody who's just simply betting, they don't have anything to do with rubber, but they're studying geological data, temperature in Brazil, India, they're figuring out what kind of rubber production will be this year, production is going to be bad, prices will go up, let me bet on it. How to bet? Use derivatives. Let me bet on it. So those speculators can profit, provided they are able to forecast correctly. Provided they are able to forecast correctly. In the long term, please understand, how do you calculate inflation? What is inflation? Increase in prices of commodities, services, goods and services broadly, or if I can say increase in price of commodities. So whatever is the change in price of commodity, that is equal to inflation. Can I say that? At least in the long term. In the long-term horizon, over a 5-year, 10-year kind of horizon, can I safely say that the change in price of commodity should be equal to inflation? And commodity does not give you any interest, dividend, anything? In the long term, the return from commodities change in price, which should be broadly equal to inflation. Whatever is the inflation rate, your commodity prices, the change in commodity price is going to be more or less inflation. Your real return is equal to 0, think about it. Time value of money first class. Real return, your nominal return is equal to real return plus inflation, plus risk premium. There is no default risk, credit risk, maturity risk over here. In commodity, there is no default risk. Default risk is when you're giving loans and all of that. Tell me, are you following this? So your nominal return is equal to real return plus inflation. If my nominal return is equal to inflation, then real return has to be 0, na? Your Your nominal return is equal to real return plus inflation. We did that example with an apple. Your bank is giving you 7%, apple price increased by 5%. So how many apples can you actually buy? 1.028 or something, if I'm correct. 0.46, and another example I've taken, another numbers I've taken. So nominal return is equal to real return plus inflation. But I'm telling you that the return from commodity is equal to nominal return. Commodities return is change in price. Change in price can be represented by inflation, at least in the long term. Short term, I know there can be a lot of fluctuations. But in the long term, the change in price is more or less inflation. So my return from commodity is equal to inflation. If this is equal to this has to be 0. So in the long term, real return from commodities is equal to 0. Real return from commodities in the long term is going to be equal to 0. Then why are you still investing in commodities? One was diversification, and second, it can act as an inflation hedge. It will act as an inflation hedge. Because I'm scared of inflation. Why am I scared of inflation? Because it reduces my purchasing power. The amount of goods and services that my 100 rupee note can buy today, can purchase today, is not the same. I'll be able to purchase less than 100 rupees in the future. What if inflation, I was expecting inflation to be 4%. What if it turns out to be 6%? I'm scared. But if I invest in commodities, if inflation is 6%, my commodities will increase by 6%. If inflation is 4%, my commodity will increase by 4%. So by investing into commodities, I'm locking in an inflation rate. There is an inflation hedge over here, because commodities will increase on an average, in the long term at least, as much as inflation rates. So even if inflation is high, commodities will be higher, giving me higher return. If inflation is low, commodity will give me lower return. So I'm able to hedge myself. I'm able to hedge against inflation, against loss of purchasing power. Because my currency, my 100 rupee note, will be able to purchase less amount of goods and services in the future. Tell me, understanding this?
So
following this?
Whatever is the increase in price, that is the inflation.
Increase in price is the inflation, no?
So,
but in the short term, you cannot say that, because in the short term, there could be a lot of fluctuations. So you cannot exactly say that every 2 months I will hedge my inflation, or every 1 day I will hedge my inflation. We don't calculate inflation on a daily basis that way. When you're looking at inflation hedges and all, and inflation is calculated for a larger, broader spectrum of commodities also.
So the inflation, which the difference between the two is the inflation, only in the commodity or the entire economy?
Inflation is on commodities. Now in economy, what? You will not say that share prices have increased and that is calculated under inflation. Inflation is about the consumption, about commodities. Yes.
So another question. So you said that
you can calculate inflation also, human index inflation all. So the increase in wages and all people are demanding. But again, you have to understand, if commodity prices increase, then people will demand higher wages also. Ultimately, the salaries, the increase in salaries and all also depends on the kind of inflation in the economy. Because the workers would want to restore their purchasing power parity, right? If inflation is high, the wages, the laborers are also going to be asking for higher wages, because they want to be able to consume as much as they were consuming earlier.
So you said that the return on commodities is low, but commodity ETFs and managed futures, they will basically invest in derivatives.
They can try to generate more amount of money, but they will not be able to generate extraordinary money.
But the derivatives are very risky. They will give more return.
No, derivatives are very risky, so they will also make losses. And it is derivatives on commodity, so the changes will be based on commodity. It's not that commodity will increase from 10 to 100 tomorrow, and because my inflation is 5%, it will become 10.05 or 10.5 day after. You have to understand, commodity cannot become 10 to 100, 100 to 200. It will increase more or less around inflation. But yes, there are short-term fluctuations which you will try to capture. And ETFs does not mean that they will be taking risky bet. It could simply mean that I'm having an exposure through derivatives, because I cannot keep oil at home. Does not mean I'm betting that, okay, oil will go high, let me buy a lot of oil today, let me buy less oil today. They will not do that, because I cannot keep oil at home. So I will take an exposure that, okay, after 6 months, I will buy 1 lakh units of oil. After 6 months, what they will do? That previous contract they will sell, and they'll buy another 1 lakh units of oil. So they will keep on rolling over. You'll understand these things when we do derivatives. You'll keep on rolling over the contracts. So here they are not trying to do speculation. They're using derivatives to get exposure to oil. The objective, speculators do that. We are not looking at speculators from an investment point of view. Speculators, can you forecast that, okay, price will increase, you do your betting and trading and all. That is not what we are discussing as an asset class over here. When you're looking at these commodity ETFs and all, if they're using derivatives, they're not using it to speculate that today price will increase, 100 unit kharido, kal becho. They're not doing that buy sell continuously. They're using derivatives to get exposure. You cannot take oil at home and keep it, or you cannot bring sacks of rice and keep it at home. So they enter into a 6 months contract. As they are closing to 6 months, they'll cancel the previous contract or sell off the previous contract, enter into another new 6 months contract. So they'll keep on rolling over.
So managed futures, are they restricted to investing only in futures or other derivatives?
Managed futures, generally futures. This is this. Alright. So this is an easy part. So when you're looking at the spot price, the price of a commodity today, it is based on demand and supply. We already understood that. It's a function of demand supply. What is the price of commodity today? It is going to be based on demand and supply. Now, what are the factors affecting demand? Value to end users. Today, lithium ion becomes very useful. 10 years back, it was not very expensive, but today it has become a very important resource. Why? Because it's very valuable to end users, because everybody wants a battery car, because oil is expensive. Business cycles. So oil price, you would see that based on business cycles, the oil prices will continuously change. If there is more business activity, oil demand goes up. If there is low business activity, oil prices go down. Global economy, if the economy is doing well, lot of infrastructure projects, governments have money, iron, steel, metals, industry is doing very well, cars being sold. But when the economy is not doing very well, in that case, cars and all will not be sold, real estate, so much of investment into real estate will not happen. So cement, iron, steel, etc. may not be sold that much. So demand side, so if there is obviously, if demand increases, price increases. If demand decreases, price decreases, obvious. Another part of looking at it is the supply side. One more point over here, when you're looking at the business cycles, if your business cycles are too extreme, like COVID has shown extremes of how things can be, the prices become very volatile. 2008, you look at oil prices, ka graph in 2008 and all, you'll see the volatility. It went up to almost $140 per barrel. It came down to $20 per barrel as well. Look at the range of price of oil. One barrel of oil, $140 to $20 as well. Barrel, gallon, I don't remember the exact this thing. Anyways, so that can make the prices very volatile, the cycles and all, how the economic cycles are behaving. When you're looking at supply, gallon, not barrel. When you're looking at the supply side, production and storage cost, the production and storage cost of oil, natural gas, etc. is much higher as compared to gold or something. Precious metals, easy, that is why we call it a store of value as well, because you can store that amount, that very easily. So what is the storage cost, production cost, etc. Production cost, for example, agriculture and all, agricultural produce would be very much affected by weather. Very good monsoon also becomes a problem for the farmers. Do you know that? That is why the government needs to have very strong price floors and price ceilings. Price floor is, this will be the minimum price. You cannot reduce the price beyond this level. So if the produce is very good, if the harvest is very good, that is also a problem, because supply increases too much, supply increases too much, prices might drop, the farmers probably do not get what they deserve. I remember quite a few years back, trucks and trucks worth of tomatoes were thrown on the streets because the farmers were not getting their legitimate deserved prices. And most of it, and a lot to do is with the middlemen. So the middlemen, obviously when you're looking at the farmers, you cannot exploit farmers. But then the middlemen have been, anyways. So when you're looking at low production, if the monsoons are very bad, production is low, and therefore prices would increase. Monsoons or extreme weather conditions, too much rain is also a problem. Depending on the kind of crops, location, geography, etc. All these things will matter. And there are different locations in which different crops are grown. So whichever location is facing extreme weather conditions, etc., production goes down, prices go up. Production costs for minerals, oils, etc., the extraction cost could be difficult. Now say for example you're drilling oil out of land. So you have something called oil wells. At the beginning the cost is very low. You can drill out oil at less than even $1 per barrel. Later on it increases, because as you have drilled out most of the oil, it is very difficult to, because then the quantity of oil left is very low, very small. And the price, you'll have to dig deeper. It will take more time to extract oil out of it. ऐसा नहीं ना कुआं है और पानी निकाल लिया. It's not like there. There are processes like fracking and all. So US was using shell gas, and they were using these fracking and all these processes in order to extract oil. So these things become, so when you're looking at the extraction cost, etc., that becomes important. Of course, the extraction cost, if you're looking at offshore oil wells, is very high. Bombay High and all, I don't know if you people know about it, ONGC offshore, seabed se oil nikalna. So they are drilling out oil from seabed and seashore and all. So oil wells, offshore oil wells are exorbitantly expensive. Onshore oil wells are anyways very expensive. Offshore will take it to another level altogether. It's very expensive. So the cost of extraction, more expensive methods when you're using, or more remote locations if you're using. Now people want to even mine on Mars and Moon and everything, and they want to bring minerals, metals and all of these things. So why do you think so much of space exploration, etc. is happening? Because they want to discover newer products and all. I don't know, what was I seeing? There was some episode I was seeing somewhere, and they wanted to extract some minerals out of an asteroid that was going to crash around Earth. Okay, I started this series called Scorpion. So there was this one episode where you want to even extract minerals out of asteroid, and there was one of these countries which was trying to do something and catch the asteroid in the middle of the fall towards the Earth, because normally the asteroids turn to dust by the time they burn to dust by the time they are reaching Earth. So okay, that was a good, okay, I don't know, you might not like it. So anyways, when you're looking at this extraction cost, more expensive methods, remote locations, etc., when you're using that, the cost of production increases. If the cost of production is going to increase, obviously, then prices will increase. So supply, storage cost, production cost, existing inventory. If you have a lot of existing inventory, the price will increase or decrease? Decrease. Supply increases, price decreases. You're not being able to sell your existing produce. At times, things become redundant, things become less useful, right? I've covered all this. Inelastic, supply is again inelastic in the short run, as we were discussing about the semiconductor chips and all. So it might take time for you to set up alternative factories, alternative production methods, etc., which is what people are trying to do, because nobody wants dependence on China to that extent today, because of the risk of having production totally concentrated into one country. Tell me, are you following this? But it will take time to gain alternatives. If you want to establish an alternative to a product, so say for example, there is right now we are looking at alternatives to lithium-ion batteries as well, because we do not want to have dependence on one particular metal. How many electric cars would you be able to manufacture with that amount of lithium-ion batteries and lithium-ion and these minerals available? So that is a problem, right? Lead time for production. So obviously it takes time, even if, say for example, the volume of oil available is low. What do? You cannot just simply start drilling. You'll have to explore, you'll have to figure out oil wells, new oil basins and all, and then you'll have to set up oil wells, construct it and all of that, and then drill out oil. There is a lead time for production. So just because supply is inelastic in short term, so there's a sudden demand for something, you'll not be able to meet the supply. When COVID happened again, we had a sudden demand for masks, sudden demand for sanitizers. But again, we people are very good with all these things. And everybody jumped right into business, and there were so many people who did so much. In fact, using alcohol and all to make sanitizers at home, liters and liters of sanitizers, 5 liter ka bottle bik raha tha. That's great. We are able to come out of any kind of situation, be it sanitizers, masks, the kind of vaccination. So, but again, it was inelastic for a very short time. Then again, everybody, the schools, colleges, universities, they all went to online mode, and the way they have managed, it's commendable. You know, I mean, like, I was just talking to my sister in the morning, and she received a notification because my nephew logged out. So she got a notification, and she immediately called him up. Why the hell are you not online? Why did he log out? And then he's making excuses. You're understanding? So how we have adapted towards technology in the post-COVID scenario. Think about it. In the very short run, supply is inelastic. There are so many companies who jumped into it, to that opportunity, Zoho, etc. Right? So this. Then how do you form future expectations? So how do we kind of forecast what will be the commodity prices? What should I do? Say for example, even in something as a simple business, you're running a small factory, or you're running a small shop, a toy shop you have, very small toy shop over here. You will have to have an idea about USD prices, because most of your, unfortunately, most of your purchases are from China, which is based out of, your currency is based in USD. So based on USD prices fluctuation, your import cost increases or decreases. So everybody gets affected. So even when you're looking at the smallest of businesses, they will try to forecast that how do I see the prices, metals. My uncle, he's got a iron and steel related business. So obviously he has an idea, he'll try to forecast, he'll try to accumulate raw material when the prices are low. When he thinks that the prices are going to be decreasing, he'll probably reduce his stock and sell off more so that he's able to purchase it when the raw material prices go down. So we do all these things. So how do you forecast? So it's not just about trading or just about investment. So even when you're looking at commodities, any manufacturing concern, any kind of business you're doing, you'll have to be able to forecast commodity prices and all. The USD was currency example, sorry. So what are the producers going to be looking at? Government policies and all. When you're producing commodities and all, how much of mining will be allowed? Sterlite, copper, shutdown. Again, a lot of, I think I had mentioned this in the previous class. So what is the government policy around it? The government is not enabling us to produce copper, and most of it is being imported right now. Otherwise, I think we can take care of at least 40% of copper consumption of the country. So, what are the economic events happening? What is more in demand? Economic events, demand for what kind of products is there, like lithium ion, semiconductor chips is required. So what commodities should I go about it for that? Scrappage policy is going to be there. So how is that going to be impacting the availability of iron, steel and all? Scrappage policy in automobile. So how is the economic policy, government policy impacting? What is the expected supply in the future? Like expected supply of oil, we would obviously have lower expectation in future because it is a non-renewable resource. So therefore, we need to move towards alternative sources of energy. Investors, what are they going to look at? Again, government, expected supply, etc. Investors are also going to look at that. Investors will also see what kind of inventory is there built up in the market. Because if the inventory is high, we would want to lower our expectations. The prices could be going down in the future. I'll give you another example. Suppose I'll also try to evaluate what is the situation of Middle East countries. Dubai, Qatar and all these people are trying to move towards becoming a financial hub and a tourism hub, because they know that they cannot be dependent totally on oil in the very, very long term. Right? So they're trying to change towards that. Right? So when you're doing these things, so even as investors, I would like to figure out as to what would be the prices of oil, what is the inventory, what is the debt to GDP of these countries. Are they going to increase supply of oil or reduce it? How much economic requirement do they have? When you're looking at the Middle Eastern countries, these people have amazing amount of money with oil. These people have invested across the world. So it's not that the economy is dependent. They have huge amounts of investments across the world. Factors of production. So if say for example something is very labor intensive, whatever raw material, say suppose the raw material that you're mining or agriculture is quite labor intensive. So whatever you're manufacturing or producing, whatever commodities you're mining, if it is labor intensive, what will be the prices of labor? How will the price of labor be increasing or decreasing in the future? How will the factors of production be, and how would the prices move accordingly? Tell me, comfortable till here? So we've analyzed these factors in order to form expectations about the commodity prices in the future. Last part is this you will be able to do with derivatives. So futures price formula is done with derivatives. Say suppose, I'll just give you one line, otherwise just get back, because this is the most important equation when I'm looking at derivatives futures. So we do this in futures. So futures price, that is, say suppose we both were contracting that after 6 months I'll buy something from you. So that price is the futures price is equal to the price today, spot price, plus interest plus storage minus convenience yield. I think I will leave this equation as it is because I take a good amount of time to cover this in derivatives. Just come back to this equation later once your derivatives is done. You'll automatically know this and convenience yield. So convenience of holding the asset, convenience yield. I've covered all this in derivatives. Just one line, let it be right now. And there are two terms you'll have to remember. If futures price is more than spot price, we call it contango. If futures price is less than spot price, we call it a situation of backwardation. So if today's price is, let's say, 46,000 rupees for gold, and I don't know, I've not seen the exact price. And if we contract that after 6 months, I'll buy gold from you at 47,000, that is contango. 47,000 more than 46,000. Future price, the contracted price is more than the current spot price. That is contango. And if futures price is less than spot price, that is backwardation. These two terms you'll have to remember. These two terms have not been covered in derivatives probably. This equation is there. So once you've done with derivatives, just come back to this one line later. This completes your commodities. That is it. So understand commodities with respect to the entire alternate investments part. Just this one bit you do it once your derivatives chapter is over. Okay, this completes your commodities part.